I think the real money is in front of us. I think that for several reasons, but the most important of that is that we now have the incentive price necessary to add to production. And importantly, because the volumes in the uranium market have switched from an uncertain spot market to a much more certain term market, it means that the revenues that companies will enjoy from putting a mine in production are predictable and visible and financeable, which means that companies that couldn't finance, even at $90 a pound, if that $90 was realized in the spot market, will be able to finance if their production is sold into the term market with a credit grade counterparty.
Hello and welcome back to Capital Cosm. Today I have a very special guest returning back on the show. What better way to close off the year than with Mr. Rick Rule? Rick, thanks for coming back on.
Pleasure to be with you. Thank you for having me back.
Yeah, as always, nothing in this video is financial advice. I am not a financial advisor and neither is Rick. But with that said, Rick, I think the audience pretty much knows who you are. We've had you on the show before, and you're a legend in this space. I've also come to realize that when it comes to mining investing, it's not just all about picking the right sector, whether it be gold, whether it be silver, whether it be copper, etc. It's also about being able to identify the right value in terms of companies. And throughout the entire mining process, you've got various types of companies. You've got pre-production, development stage, and production stage. And so I'd like for you to kind of walk us through the importance of each of those stages.
What you said is something I'd like your audience to reflect on, because it's very important. There are different ways to add value in the sector. There are different risks and rewards to every aspect of the sector. And when I say the sector, you can subdivide it several ways. One would be by commodity, gold, silver, iron, as an example. Another would be by stage, early exploration, advanced exploration, development, construction, production, merger and acquisition. And then, of course, there's division, as an example, geopolitical or political risk. Division is a deposit in Congo, as an example, rich enough that you can overcome the supposed political risk of being in the Congo, or should you be in a jurisdiction that you believe at least is less risky? So what you suggest is very true. There would seem to be an investment matrix around most subjects, and understanding the matrix is important. Having pontificated, now let me get into an answer, I think, in the way that you intended it. I think it's important to note, too, that when you look at the matrix, different markets price risk and price reward differently. So there are points of time, as an example, in the early part of the 1990s, when the industry made some profound discoveries. And what happened was that exploration came into favor, and people were paying up for exploration stories, not because necessarily that the future was going to lie in exploration, but rather because success had been demonstrated in the immediate past with regards to the exploration thesis. So I think it's important for the intelligent investor and speculator to understand which part of the investment matrix is most attractive to them in terms of their outlook, in terms of their risk tolerance, in terms of their time preference, but also which part of the market is undervalued in the market relative to others and which is overvalued in the market. I hope that that's a useful introduction for your listeners. In terms of stage, I have enjoyed a lot of success myself in real exploration, which is to say the earliest stage, riskiest sector. In this circumstance, the expectation, the probability is failure. You do it because you can fairly easily screen out the companies that have the highest probability of failure. You do that by screening for explorationists who have a track record of success. The success accrues to a fairly small number of people, and the rewards can be stupendous. I think back as an example to Arequipa resources, 30 cents to $30 in 19 months. The financial reward that accrues to exploration success is unlike financial reward that accrues anywhere else in mining. It's much more like research and development technology. That being said, the high risk nature of it means that it's unsuitable for many people, both financially and psychologically. The amount of time it takes, too, makes it financially unsuitable for many people. But I think it's important that people understand that the early stage exploration companies, if one learns how to do it, generate the highest risk and the highest reward in the sector. Much more tolerant to most people are what I call the discovery plays, where you have done a job targeting. In other words, you have done whatever surface work you need to do to determine that there is mineralization there, but now you need the third dimension. You got to quantify tonnage and grade. So you put a hole in it. After a discovery hole has been put in place, that's called discovery stage exploration. That becomes much, much, much lower risk. Risky to be sure, but lower risk. Similarly, lower reward. In Arequipa, in the prior example, the grassroots exploration phase, the prospect generation phase, the 30-cent phase, the stock went really from 30 cents to $4 on discovery. It went from $4 to $30, certainly an attractive response, but in terms of percentage gains, not as attractive in the sort of discovery phase. So I think you go from grassroots exploration to discovery phase. Once you've gone through discovery phase, once you have delineated the deposit, once you've published a document, well, a resource study, first of all, and a preliminary economic assessment, you're in something called the pre-development or development stage. You have a sense that you have a deposit, you're trying to define the economics, and you are trying to drill off and delineate the project to the degree of certainty that's necessary to attract the financing to put that deposit in production. And I define this stage as post-preliminary economic assessment, but pre-production.
Got it. This is basically the Lassonde curve, no?
Exactly. This is the boring part of the Lassonde curve. If you look at the Lassonde curve, you have these wonderful parabolic moves at the beginning in discovery and delineation. And then you see the thing peak for a while once you have sufficient knowledge and sufficient excitement. The development stage is boring. Rather than getting these wonderful drill holes and having, visions of sugar plums at Christmas in your mind, you are reading press releases about discounted net present value, about expected power costs, about environmental impact statements, all that kind of stuff. Right. You got it. You got it perfectly. The so-called orphan period. From preliminary economic assessment through perhaps financing, which is described on this curve as development. I would describe this whole period as pre-development and development. What's important to note is that second wave up, generally, by the way, a little less steep than is shown on the Lassonde curve. That second wave up, while it's less dramatic than the first wave up, is much more certain. It's much, much, much lower risk. And there are periods of time, generally towards the end of a bear market, which is where I suspect that we are right now, where the certainty in the development stage is underpriced by the market. When a sector has failed to provide adequate returns for investors, for as long as junior mining has, there is an expectation that the rewards will be constrained in the future. In fact, this development period where you go from the boredom at pre-feasibility and financing to real progress towards on-time, on-budget completion, and then completion of nameplate capacity. The certainty involved in this circumstance gets undervalued by the market because the expectations are low. So from my viewpoint right now, the two sectors for speculators in the mining market, which are the most undervalued, are the really early stage conceptual and pre-discovery grassroots exploration, particularly the prospect generators, which we'll deal with at a future boot camp, but more particularly for most investors in the development and pre-development stage. It's important to note that you need to understand something about the financial stack that goes into mine construction. You need to understand how to read a resource statement. You need to understand the fundamental part of the analysis of pre-feasibility studies, of preliminary economic assessments, and particularly bankable feasibility studies. And you need to develop the skill set to understand how to visit with IR people and how to read press releases, to understand the probability and the time frame around on-time, on-budget completion, and much more importantly, completion at nameplate capacity. Remember that once you build a mine in the beginning, it isn't necessarily very efficient at processing ore. The mine itself needs to be broken in, and it's important to get full valuation from your investment, that you are prepared to hold the stock through the completion of nameplate capacity, where either nameplate capacity, where either the stock goes up or if it doesn't, it gets taken over. It's important to understand that process. That's why we're doing this boot camp, this upcoming boot camp on pre-development feasibility and development.
Yeah. So this is your virtual boot camp that's coming up on January 6th. By the way, you can find a link to that boot camp in the description box below. I highly recommend you check it out. You've got the likes of Rick Rule, Lobo Tigre, a litany of other guests, Rick, joining you as well. And
I should note that financially this is riskless. We charge you $99 to attend. You have access to the tapes for a year, and you have access to subsequent interviews that I do after the boot camp, where you get to put the lessons that you learned at the boot camp into practice for free. We charge you $99, but importantly, this $99 is 100% refundable. This is a gold-plated guarantee. If you don't think that you got $99 worth of content in the 8 or 8.5 hours that we're going to put this on, absolutely positively email me. I'll give you your $99 back. Mercifully, in 30 years of these money-back guarantees, I've had to refund less than 0.1% of the tuitions I've charged. So I'm highly confident that you'll get your money's worth. But if you don't think you have for any reason, tell me. I'll give you your money back.
Yeah. We were just looking at the gold price the other night on the live stream here on this channel. And, there's predictions being thrown out there for $3,000 gold in 2024. I don't know exactly where it's going to go, but it's been making some serious moves to the upside. Silver and copper has actually been moving as well. So I think, this is, if there was ever a time to get serious about mining investing, now's the time. Speaking of which, Rick, what do you make of the current gold price? Gold is sitting at just under 2,100. It shot up, made a new all-time high a couple weeks ago, went back down to below the 2,000 level, and then retraced back up to make an all-time high close for the day at, I believe it's 2095. So what's been going on there with gold?
We could do a whole show on the gold price, but I'll try and constrain it. First of all, when people talk about an all-time high, they're talking about an all-time high in nominal terms, not in real dollar terms. If you inflation adjust the gold price into US dollars, what you'll see is that it isn't at an all-time high at all, that it has lots more room to run. I need to say that I don't pay any attention to the gold price at all in the short term. And I have absolutely no interest in whether gold's at 2,100 or 2,200, or for that matter, at 1,900. I own gold because it is, for me, the best financial insurance class of any asset of its type in the world, and has been for 1,000 years. I own gold not because I think it might go to 2,500, which I do, but because I'm afraid in any crisis of confidence, afraid that it'll go to $7,000 or $8,000 or $10,000. I own it as insurance. And by the way, I really, truly hope it doesn't go to $7,000 or $8,000 or $10,000. The set of circumstances that would cause gold to go that high would change many aspects of your standard of living and my standard of living. And by the way, not for the better. So I own a lot of it, and I hope it doesn't go up a lot, but I think it will. I think that investor expectations around gold were really put in place in the 1982 to 2022 timeframe, the most benign economic climate probably in the history of humankind. The interest rate was falling, the US dollar was strong, globalization in a good sense was happening, demographics, favored investors. And the outcome of all of that was an expectation of financial markets that was confident. I think that's begun to change. Interest rates, in a real sense, probably won't be falling. They may be manipulated lower for a while. The baby boomer demographic has peaked. There's increasing geopolitical tension. I think the next 10 years will be very different than the last 40 years have been. At the same time that I think that the level of government, which we've become accustomed to and believe that we could afford over 40 years, will become unaffordable in the next 10 years, which is to say, I expect some turmoil. And I expect that that turmoil will reduce faith in the maintenance of purchasing power of people's savings in US dollar denominated savings products and instruments. And hence, I suspect that gold will do very well. As I say, I don't own it because I'm looking for a move to $2,500. I own it because I'm afraid of a move to $8,000. I don't own it with anything like 100% of my net worth. Because in my experience, when gold moves, a little bit of insurance pays you a huge benefit. I lived through the decade of the 70s, $35 to $850. This was not a 20% move. I lived through 2000 to 2010, $256 to $1,900, not a 20% move. In fact, when people ask me now, Rick, when's the gold price going to move? I tell them I began rebuying bullion in 1998. So for me, the question, when is gold going to move? The answer to that is 2000. It moved from $256 to $2,000. In other words, I got an 8-fold return. Gold has done exactly what I bought it to do. My suspicion is that the move in gold and later silver will be much more precipitous in the next 5 years than it has been in the last 20. Frankly, a fact that I view with some trepidation.
Yeah. So I was also another metal that people often look at to determine the health of the economy is copper. And I want to show you a chart really quick. So gold's been making moves, but if you look at copper priced in gold, you'll notice that the copper to gold ratio has been coming down. So despite copper's move to the upside, gold's been outperforming copper. Does that portend to, while copper might be a proxy for the economy, gold's rising even faster, meaning that maybe on a nominal scale, the economy might look fine, but in real terms, the copper to gold ratio in gold in particular is telling us that this is a loss of confidence in governments and institutions as more investors head towards, this insurance policy, crisis hedge we like to call gold.
I think the chart's telling you three things. I don't think that there is widespread consumer acceptance of gold yet. I think there's increasing fondness of it in central banks, as many central banks around the world want to get out from under the U.S. government's financial hegemony. The Chinese have watched us, as an example, weaponize the dollar, And to them, the antidote to weaponization of the dollar is gold. You're seeing this around the world, where people around the world have decided that they don't want to be exposed to the extraterritorial reach of the U.S. society and U.S. government. I don't think that fondness for gold has reached a retail level yet. I think that what you're seeing in terms of the relative strength of the gold market is all about disintermediation from the U.S. dollar in a politically inspired basis. Copper is selling you two other things. The first is that there is a genuine economic slowdown in China, that the urbanization in China has become less dramatic because the internal contradiction in Chinese society, where 10,000 people make investment decisions for 1.3 billion people, has meant that there is at least a hiccup in the Chinese growth story. And the third lesson, I think, with regards to copper, is that in many investing institutions, there is a sense that a recession is a high possibility, if not a probability. And although everybody knows that over 5 years, copper production on a global basis will decline almost no matter what we do, people are afraid that demand for copper will fall at the same time that supply of copper falls, muting any price gain that people might enjoy. From my own viewpoint, where my investment horizons are longer than most people, I look at the decline shortfall in copper, and I'm willing to accept myself price weakness in the interim as the price I have to pay for owning as much of high quality deposits as I possibly can, because I look at a circumstance where the ascent of humankind, and I'm not talking about the adoption of Teslas, I'm talking about providing power for 1 billion people on Earth who have no access to electricity, will occur with such certainty that I think at some point in time in the future, and I can't tell you when, that you'll see fairly dramatic increases, at least in the nominal price of copper. So I like both gold and copper. I agree with the conclusion, the implied conclusion of the chart, which is to say that gold probably, note probably, has more near-term upside than copper.
Got it. And then you look at as well, you look at the TNX, the 10-year treasury, it's down below 4% too. So is that kind of hearkening back to your point there that, flight into
I don't think that is. I think that's fraud.
Okay.
I think it's absolutely fraud. I think that the U.S. government and other governments have managed expectations and managed people's views of reality. I think that they, as among other things, have convinced people that the CPI is a cost of living index, which it isn't. And I think that people's view of inflation is very, very, very wrong. People have been schooled that inflation is running at 2.6% because that's what the CPI says. With it running at 2.6%, they're willing to accept a 4% yield on their savings. My own view is that the CPI is, first of all, hedonistically adjusted, which means that the people who construct the index assign values to things like housing and technology, values that are unrelated to the price that the consumer pays for those goods. But much more importantly, the CPI, when it's inconvenient, doesn't include food or fuel. Not much of an index for people who need to eat. The most important shortcoming from my point of view is that the CPI doesn't include the cost of taxation and government. If I didn't have to pay the tax, I guess I might bitch less about the index. But my belief is that my cost of living is increasing at about 7% compounded, if you include tax. What that means is that if my savings are deteriorating at 7% compounded and the U.S. government is paying me at 4%, they are guaranteeing me a loss of purchasing power of 3% compounded a year for 10 years. Jim Grant calls this return-free risk. For that reason, I think that a treasury that pays you an interest rate manipulated by the Fed is the ultimate form of fraud.
Yeah. I mean, you could say that 2023, in the eyes of many, was the year of bonds. Getting, you're earning 5% passively, risk-free return. as you put, or you said the opposite, right?
I said return-free risk.
Return-free risk, yeah, return-free risk.
If you're getting paid 4, and the purchasing power of what you're getting paid in is declining at 7, what you're really doing is losing 3, not making 4.
Yeah.
Now, ironically, I have a fair bit of cash, and I regard my negative yield personally as an option premium, because I know that if we have a liquidity crisis, and I'm not saying we will, but I am saying we might, if we have a liquidity crisis, that cash will give me the means and hopefully the courage to take advantage of the situation rather than being taken advantage of. This is a lesson that I learned in 2008, where I was fairly liquid. And that meant that 2009 was maybe the best investing year of my career because I was able to take advantage of the liquidity squeeze in 2008 to invest fairly aggressively in 2009. So paradoxically, despite the fact that my cash holdings are costing me 3% compounded, I have large cash holdings because I regard that negative interest as an option payment.
Yeah. So 2024 and beyond, it looks like the Fed is signaling towards ceasing their rate hiking cycle. Seems like that's coming to an end. There's also been some hints being thrown out there that rate cuts, a good number of rate cuts, might be down the pike there. But regardless of all of that, the market's still making all-time highs. Right? Has the market already priced in those rate cuts? Has the Fed essentially cut rates without actually cutting rates?
I don't know how to answer that question. I'm a student of companies rather than a student of markets. I regard the market as a facility for buying and selling, ownership of individual businesses. So for me, the market isn't a topic. It's a market. I believe that the bullishness in the market may very well be a function of declining interest rates. If you lower the cost of capital to corporate America, you give them the ability to increase earnings faster than they otherwise would. Mm-hmm. At the same time that you cause the value of a dividend stream, the capitalized value of distributions, to be higher. So if you require a lower discount rate on your dividends and your cost of capital goes lower, it should theoretically increase the value of those dividend payers. And that ebullience, which might occur in equity markets as a consequence, could spill over into more speculative markets. At the same time, the incredible disintermediation that you saw in the bond market, the destruction of the bond market, the destruction of at least nominal wealth that occurred in the bond market, comes to an end. If interest rates fall, bond prices are strong. So I suspect that the ebullience you're seeing in financial markets may very well be a consequence of the market's belief that interest rates are stable or may in fact decline. If interest rates decline, if the real yield on borrowing goes more sharply negative, if past is prologue, you'll see a return to 1975, which is to say that you will see a period, I would suspect, of much stronger precious metals prices than people otherwise believe.
Got it. So 2024 could be the year of the precious metal sector?
I suspect that 2024, if the circumstance that you and I have just described takes place in 2024, that in a historical context, 2024 will resemble what 1975 was, a period where gold consolidates and then breaks out like crazy.
Yeah.
People who didn't experience the decade of the 1970s should be reminded that the early part of the 70s exhibited incipient inflation as a consequence of the guns and butter policy. And when the gold price was deregulated, the price went from $35, if my memory serves me well, to something like $200.
Yeah.
In late 1974, 1975, the interest rate was allowed to rise, which cut the gold price in half. We didn't see that this go round. We saw the interest rate increase at the same time that the gold price increased. But in late 1975, when the Fed lost its nerve, and reduced interest rates, what you saw is that the market saw that the Fed wasn't serious about inflation and Congress wasn't serious about inflation. And gold really, truly went on a tear. It went from $100 an ounce, if my memory serves me correctly, to $850 an ounce in 6 short years. If the market perceives, and I think the market knows, that Congress is much more interested in spending than they are in fighting inflation, and if the Fed loses its nerve, I think gold would really, really do something. I think that the Fed can say with a small degree of accuracy that they have engineered a soft landing. The economy is intact. It isn't intact for those people who've lost their jobs. The real estate market hasn't collapsed. It's just that liquidity has disappeared. We haven't yet felt the impact in the banking system of the problems that are in front of commercial real estate, particularly office real estate. And I think the Fed can say, we did what you asked us to do. We've engineered a soft landing. I think there's tremendous political pressure and tremendous pressure among the voters to lower the interest rate. And I suspect if they can get away with it, that they're going to do it.
Yeah. So, gold's been surging, like you alluded to, but the market's also forward looking. Why is it that the gold mining equities aren't sniffing out, this potential rise up in gold? Does that portend to a rebound back down because the equities aren't really believing the gold price? Essentially, what do you think is going on there?
2 answers to that question. Gold is of interest to you and I, but nobody else cares. The market share of gold, precious metals and precious metals related assets in the U.S. is less than 0.5%, which is to say less than 0.5% of all savings and investment assets in the United States is denominated in gold. The truth is, with regards to gold, other than a small group of us who live in the gold ghetto, nobody cares. Just like 1968, nobody cared. 4-letter word, nobody could spell it. So the first part of gold malaise is that for the last 40 years, nobody's needed it, nobody's wanted it, nobody's cared about it. I think that's important to understand. I think that all of that is going to change. I think with regards to the gold equities, though, that a lot of the fault is the fault of the industries. In the last gold bull market that we enjoyed, the period 2000 to 2011, the gold price moved from about $250 an ounce to, if my memory serves me correctly, $1,850 an ounce. And the free cash flow per share in the Philadelphia Gold and Silver Index fell. The industry reacted to a 7-fold increase in the gold price by delivering lower free cash flow per share than they had at the beginning of the decade. The investment industry, at least that part of the investment industry that cares about the gold mining industry, believes that the gold mining industry is run by such a bunch of knuckleheads that even if the gold price triples, that the gold mining industry will fail to deliver profits. I happen to believe that for the next 2 or 3 years, that something very different is true. I believe that the institutional investors will exert much more adult supervision on the gold mining industry than was exhibited in the early part of the decade 2000 to 2010. And I note from personal experience that about 80% of the managers who presided over that really despicable performance were allowed to pursue other employment opportunities. And I suspect that at least for the next 3 or 4 years, that the capital will be deployed much more efficiently than it was last time. So I believe that we're perhaps facing what might be a perfect storm, which is to say increasing gold prices and increasingly efficient capital allocation. No guarantees on the second one, of course.
Yeah. I mean, this is why it's extremely important to be able to pick out the right companies with the right deposits.
It's all about stock selection. It's all about stock selection.
Yeah, it goes back to your virtual boot camp. I just want to highlight that one more time. You just have to pick the right companies. You can't just say, "Oh, I'm just going to invest in the GDX," and be honky dory. That might not work out entirely. You might not be able to trace up that move in the gold price should it precipitate. I want to take the conversation over to energy now. Uranium has been the talk of the town. It's been the lone exception in the energy space this year. Oil and gas is down, coal is down, all these other energy sources are down, but uranium sitting at $91, broke through, up over, I want to say close to 80% year to date for the year 2023. But at the same time, you're starting to see the same kind of pattern repeat with that we talked about with the gold mining index, with the gold miners, that we are with the uranium mining equities. So while the metals price may have risen 80%, the URNM ETF, for example, has only gone up 50%. And even while uranium continues to make new multi-decade highs, or decade-long highs, the equities are kind of like stuck, in this, in the case of URNM, in this $47, $49 zone. So what's been going on there?
A couple things. The first is a realization among professional speculators that the easiest money has been made. My personal holdings of juniors is much smaller because the move from hated to loved is the easiest move to make money in. But that presupposes that you bought the stuff when it was hated, which most people didn't. With my basket of uranium juniors, and I don't think in 1 year time frames, I take them back to 2021, 2022. They were uniformly up 300 or 400%. And the price is not going to go. I mean, in the last 3 years, the price went from what, $25 to now $90. The idea that the uranium price is going to triple from here seems unlikely to me. So to me, for the juniors, the easy money has been made. I think the real money is in front of us. I think that for several reasons, but the most important of that is that we now have the incentive price necessary to add to production. And importantly, because the volumes in the uranium market have switched from an uncertain spot market to a much more certain term market, it means that the revenues that companies will enjoy from putting a mine in production are predictable and visible and financeable, which means that companies that couldn't finance, even at $90 a pound, if that $90 was realized in the spot market, will be able to finance if their production is sold into the term market with a credit grade counterparty. If you have a sales agreement in place with Tokyo Power or China General Nuclear or Duke Power or Southern Company, an investment grade counterparty, you can literally take that to the bank to finance a deposit, which means that companies that were unfinanceable in the last cycle at higher uranium prices are financeable today because of the revenue certainty. So while the easy money has been made, the sure money is ahead of us. Now, to make that sure money, you need to invest in companies that can take advantage of it. Many people say, Rick, with uranium at $90, how will that impact the fortunes of amalgamated moose pasture uranium explorations? And I need to say, if the price of something that you don't have any of, but rather that you're looking for, goes up, it doesn't have any impact on the valuation of a company that doesn't have any uranium. So it's important to note that there are probably 85 uranium juniors out there, probably 12 of which are viable, which means, again, security selection is all important. All important. In truth, it could be said that for the investor in uranium, you need to own Cameco. Or if you can tolerate political risk, you own Cameco and Kazatomprom. Kazatomprom being a much better company, but one that exhibits real political risk. If you want to take advantage of the beta throughout the value chain, by all means, buy the URNM. There are some companies in that ETF that I wouldn't own with my own money, but the truth is that I've spent thousands of hours trying to determine how I might allocate my own money. And most people have lives. And for them, participating in the market beta is probably more important than the alpha that you might get from an optimized allocation. But the lesson is important. The lesson is that to make the easy money, simply speculate in what's hated. And the time for that is past in uranium. Now, conversely, the rest of the energy complex is attractive to me precisely because it hasn't done well. oil and gas companies are worth much more than the market is paying for their net present value, and there's certainty around it. And even more undervalued are the coal companies. People love to hate coal, despite the fact that the greatest year in recorded history for coal demand was 2022, and that it was eclipsed in 2023. The outlook that coal enjoys, if that's the right phrase, is that it's an energy pariah that will cease to exist in 2030. That's only believed by people who are as deluded as President Biden, Prime Minister Trudeau, or my favorite energy physicist, Greta Thunberg. For the rest of the world, we understand that there's 1 billion people on Earth with no access to primary electricity. Those people want to live like you and I live. And that takes power. And, you know, it's important, since we're having this discussion, to talk about carbon. I'm of a mind that we shouldn't be pumping deleterious materials into the atmosphere or into the oceans. I get that. I understand, however, that people like you and I have pumped much more into the air and the oceans than poor people have. When all the big thinkers in the world, 80,000 of them at last count, fly private planes to Davos, or pardon me, to Dubai, to tell you and I to drive less, there are several important lessons there. But the most important ones, I think, for Western investors to understand is that citizens in emerging and frontier markets believe that carbon should be regulated per capita, not per country. And the idea that China generates more carbon than the United States is understandable because there's 3.5 times as many people there. If you measure carbon output per capita rather than per country, what it means is that the burden of carbon will fall on Western, not Eastern consumers. But it gets more interesting than that, because they, meaning people in emerging and frontier markets, also point out that most of the carbon that's presumed to be the problem has already been released into the atmosphere. In other words, historic loadings are problematic. And those historic loadings all occurred in the West. What that means is that if you're anti-carbon and anti-coal, that you are prepared as a Westerner to absorb substantial changes in your standard of living. You're prepared to absorb $20 to $5 an hour, $25 a gallon gasoline prices. You're prepared to absorb 80 cents a kilowatt hour rather than 12 cents a kilowatt hour electricity charges, because make no mistake, if the price of electricity is going to reflect per capita carbon loadings and historic carbon loadings, that price will be paid in the United States. It'll be paid in Germany. It'll be paid in Canada. It won't be paid in India. And my suspicion is that, confronted by that political reality, people come to understand that President Biden's preferences notwithstanding, peak oil consumption will occur in 2065, not 2030. Peak coal consumption will occur in 2050, not 2050. And you need to invest around reality, not narrative.
Yeah. I mean, did you see that clip between COP28 between the Irish lady and the Dubai minister? And she was pretty much lecturing him on, the fact that, the Middle East and all these other oil producing countries are bad because, they supply the world with all this nasty fossil fuel that eventually gets turned into carbon dioxide. And he just retorted back to saying, well, you have no idea what's actually, you're swimming in a sea of energy. This notebook here is derived from fossil fuels. This desk here is derived from fossil fuels. Carpets are. It's not just oil, and it's not just the fuel that you pump into your car. It's ubiquitous. And so
I wonder if this Irish minister.
I think she was an Irish reporter. She was talking to a Dubai minister.
I wonder if she sailed to Dubai.
Minister, yeah.
I wonder if she sailed to Dubai on a wooden boat.
Yeah, and they've already given up. COP28, they've actually, they've given up on the nuclear story. So now they're all for tripling nuclear adoption by 2050, which, I had Chris Kiefer on the show a couple weeks back, and he says he was at COP28 back in 2021, I want to say. And the attitude towards nuclear back then was a 180 to where it is now. So they're already starting to capitulate.
That's very correct. That's very correct. And I think looking at the uranium story, it's odd to be, for once in my life, perhaps politically correct. We've changed the United States from a period in 4 years where President Biden would have described me 4 years ago as a profiteer on 3 Mile Island in Fukushima, to the point where, in the poorly named Inflation Reduction Act, he wants to give me $4.7 billion in subsidies. I mean, you can't make this shit up.
I got Rick the Curse on the show.
I've gone from being vilified to being subsidized. How strange is that?
Yeah. So back to let's kind of finish up uranium before we move on to oil and gas and some of the other stuff there. SPUT has been trading at a discount to NAV for the better part of a year now. So there hasn't been much buying from the SPUT side of things, SPUT Physical Uranium Trust. Yet the uranium price continues to grow. Why is it that SPUT has been, below NAV for quite some time now?
I think my former colleagues at Sprott need to spend more time talking about SPUT. I think it's true that they did a very good job tightening the uranium market. And the consequence of that is that the circumstance that they suggested would occur, which is to say that the uranium market would clear from $20 to the nominal incentive price 60, took place. People bought SPUT because they believed that the price would go from 20 to 60. The next value proposition has to be taught by Sprott to the market. There may come a time, and this is not an official Sprott position. It's important that your listeners understand that while I am the largest shareholder of Sprott, I'm not a spokesperson for Sprott. I'm not an officer. I'm not a director. I'm not an employee. I'm just a beneficiary. But it's important that people come to understand now that the most important piece of inventory in the world in the uranium business is Sprott. Sprott will not sell uranium from SPUT. But if uranium supplies got tight enough that 46 million pounds of uranium became a strategic asset, if a buyer or a pool of buyers decided to bid a premium, a substantial premium for Sprott, it might be in the best interest of SPUT shareholders to sell all of it all at once. I think it's important to explain to the market that the Sprott Physical Uranium Trust is in fact more liquid than the spot market in uranium. And that a better proxy, in fact, the only proxy, given that there's not a futures market in uranium, for private participation in the uranium market is in fact SPUT. I think logically that SPUT should trade at or at a very small premium to the spot market simply because of its utility and its liquidity. That hasn't occurred. And I hope that my friends at Sprott, who've done a very good job, I think, messaging the inevitability of the increase in the spot price of uranium, I think that they need now to refine their message in terms of the utility that the Sprott Physical Uranium Trust offers retail participants in the uranium market, participation that's otherwise unavailable.
Yeah, staying in kind of in line with Sprott, there's some controversy recently with URNJ and URNM having to share to pay out dividends to their shareholders and thereby selling off a certain amount of shares within their ETF and thereby bringing down the entire uranium equities market in the process. Now, mind you, URA is doing the same thing. I think they already did the same thing. Yep. So it's not just one thing that's isolated, particularly to Sprott. Is that another? Were they selling off a significant amount to the point where they would actually impact the equities to keep them kind of suppressed at this level?
I think what happened, and I'm making this up, okay?
Okay.
I'm answering the question as best I can, uh, by way of saying that the ETFs became extremely liquid, in particular the Sprott ETF. And an extremely liquid ETF held some fairly illiquid positions under it. People, I think, rightly decided that they wanted to participate in the beta of the uranium market, but they didn't want to spend 100 hours to learn how to become a uranium stock investor. So they bought the uranium ETF, which in turn bought some of the underlying juniors. And the junior ETF, of course, had to buy more of the juniors. What it meant was that there was dysfunctional liquidity, much more liquidity at the ETF level than there was in the underlying equities. The second thing that happened is that the ETFs and the companies performed fairly well. And so there were taxable events. And the ETF manager had two choices. He could create phantom income for the owners of the ETF, which is to say that they were responsible on an individual basis for their individual interest in the gains, or else they could realize the gains and distribute out to unit holders enough money to pay the imputed tax. They chose door B. By choosing door B, with the liquidity being so much greater at the ETF level than it was in the markets of the constituents of the index, there was a disproportionate impact on the share prices, which is, in effect, Sprott was penalized for their own success. Something which I hope happens again and again and again.
Right, right. I want to share my screen with you really quick. And this is a chart that I've looked at a bunch of times on the show. I'm sure regular audience viewers are getting tired of looking at this chart. But can you see this URA
Yep.
Versus institutional ownership chart? So basically what you've got here is you've got in black the URA stock price. Yep. And then in green, these green bars denote the volume of institutional ownership for URA. So essentially smart money ownership. And one thing you'll notice is that as the black line kind of consolidates down, you can't really see it after the bars juxtaposed on top of it, but the green bars keep growing, basically telling us that while retail sells down, institutional money flows into the sector at rapid pace because URA is the most liquid ETF in the sector. Is that the correct way to interpret it? That is to say that institutions, smart money are piling up into the sector, and it's really the retail money, the money that doesn't know any better, that's been kind of like responsible for some of this consolidation.
I'm laughing because I've been an institutional investor and known institutional investors for 40 of my 50 years in investments, and characterizing us as smart money is not always very smart, but I'll take the compliment. I think that what you are seeing is partly true in the sense that I think given the increasing political correctness around the uranium business, that institutional investors have been allowed to participate in it by their charters. I think what you saw in terms of the retail participation, that you saw some fairly smart, fairly aggressive money early coming into a sector that was very, very liquid. And so the front part of that chart, I think, was really, really, really exaggerated because you were taking extraordinarily small floats that had been really, really drastically oversold. I think, too, that to get a better picture of the uranium market, you'd have to add the Sprott ETFs in, too, because URA is an index that includes utilities, includes suppliers, includes the entire uranium value chain. And it is a less effective index of the affairs of the explorers and the producers. And hence, it's much more suitable probably for institutional ownership. You couldn't accommodate the type of volume that you're seeing in URA without having them have the ability to buy suppliers, fabricators, generators, that kind of thing. Do you follow what I'm saying?
Yeah. So I've got URNM pulled up now, and it's pretty much the same thing. There's a little bit of a gap here in the middle, but it's telling the same story, right?
It's telling a different story, though.
No?
I think if you look at the performance of the fund line relative to institutional ownership, you will see an underperformance of the producers relative to the whole uranium sector, relative to institutional ownership.
So you're saying
URA tracked institutional ownership much better.
Oh yes.
In the second half of your chart. That's all I'm saying.
Got it. Yeah. Yeah, but I mean, both of them saw a huge spike in December this month.
Yep.
So,
and I think what you're seeing is just the fact that institutional owners they're allowed to own uranium now. It's an asset class that is no longer criticized by their unit holders.
Yeah. An asset class that is not, that doesn't have that same luxury yet, though, is oil and gas. Oil's at $74. Spiked right after Christmas, but then went back down. What do you see for oil? We covered a few articles the other day here on the channel, looking at these big oil producers like Chevron and Exxon and Oxy. These guys are all going around buying up all these oil fields, hundreds of billions of dollars spent. They're looking to spend even more money next year. I think between $50 to $100 billion on purchasing oil fields. And so, you have Warren Buffett buying Oxy. Is there something that they know that the rest of the market doesn't know, given that the oil price is sitting at $74?
They know several things, and the market can know it if the market pays attention. One is that on a global basis, the oil industry is underinvesting in sustaining capital to the tune of about $1 billion a day. This includes the big state-owned oil companies, of course. And what that means is that if you underinvest in sustaining capital and new project capital investments, that your ability to produce oil 2 or 3 years from now becomes constrained, which means that production falls. And in the face of consistent demand, and by the way, demand is rising, oil prices in the out years rise. The investment community, the so-called smart money, the institutional investors, the people who went to COP28, believe President Biden for some odd reason when he says that peak oil demand will occur in 2030. So when they do a net present value calculation, they end the discount curve in the year 2000. I believe that peak oil demand occurs in 2065, which means that the net present value of Exxon's oil production at 2032 will be higher than its net present value today. And the price of oil will hold up simply because, on a global basis, we aren't investing enough in the oil and gas business. What Exxon has told you is two things. Peak oil demand will not occur in 2030 or 2032. And for them, the assets of Pioneer fit in so perfectly with the lease assets of Exxon that they will actually be able to lower their cost of production. Exxon, unlike a lot of other oil companies, is making the sustaining capital investments. They will maintain production. What Chevron is telling you is, first of all, that they want to participate in Guyana by buying Hess, and that oil and gas assets are cheaper to buy on Wall Street than they are to drill, even in the Permian Basin. And you're seeing Occidental say the same thing. Oil is cheap. Now, I'm not trying to say that the oil price can't go down below 60 in 2024. I'm not trying to say that the natural gas price, as a consequence of byproduct gas production, can't go lower. What I'm trying to say is, over the 5-year time frame, well-selected portfolio of oil and gas companies is probably the lowest juxtaposition of risk to reward available in natural resource equity markets.
Oil and gas.
They are stupidly cheap for investors, not speculators. Stupidly cheap.
Now, what kind of companies in particular? Are you referring to producers, oil service companies?
The major integrated oil companies, the most boring of all. Exxon is the best asset allocator in the oil space. Exxon has actually made a $60 billion investment that will move the dial positively. In addition to that, Exxon is committed to making sustaining capital investments to increase their production between 2 and 3% a year rather than merely maintain it. And on top of that, they have presided over a series of discoveries, admittedly in a troubled place politically, Guyana, 11 billion recoverable barrels. They've made a series of discoveries that will impact positively a company of Exxon's size. And on top of all of that, they have committed to increasing returns to shareholders via share buybacks and dividends by 14%. This is literally a case of being able to have your cake and eat it too.
Yeah. So
now, if you want to take more risk, if you want to do more work, you go into the U.S. natural gas producers. U.S. natural gas is priced at about $3 per million BTU, where that same gas in Tokyo or Shanghai or Frankfurt sells for $8.50 per million BTU. It takes $1 to get it from here to there, which means that there's an unbelievable $4 a million BTU arbitrage. That arbitrage is going to clear up. I don't believe it's going to clear up with the crude oil price falling. I believe it's going to clear up with the gas price rising. So if you're willing to take that risk, and that gap could widen before it gets narrower, then you look at names like Equitable, you look at names like Devon, but you don't need to go too far down the quality trail. You buy the biggest and the best names. If you have a little bit more courage than that, you go north of the border to Canada, where the prime minister is actively hostile to the oil and gas industry. In other words, you take real political risk. You buy in the Western Canadian Sedimentary Basin, a much more undrilled basin. And you buy names like ARC, Freehold Royalty. If you have the courage for gas-centric names, which I do, Birchcliff or Peyto, or Tourmaline. Names like that, a decently balanced oil and gas portfolio in the 5-year time frame, I think is probably the best juxtaposition available in natural resource markets today. And probably after a portfolio of very well-chosen community banks, which I think is the most hated sector in equities markets today, probably the best asset allocation that one can make if one is a contrarian for the next 5 years.
The banking sector.
Yep. Community banks.
Community banks.
The little banks, the ones everybody loves to hate.
So
notice I said well chosen.
Yeah. So you think that's more contrarian than oil and gas?
I do. Okay. Yeah, I do. I think people hate their banks, and they don't understand that not all banks are created equal. There are plenty of community banks that, unlike their big brethren, have adequate capital ratios, haven't borrowed short and lent long, don't have big portfolios of loans that they don't understand. There are plenty of community banks out there who block and tackle well, and they are hated because people won't do the work to understand them.
Yeah. So speaking of most contrarian play, 2024 is on the horizon. What do you think will be the biggest winner and the biggest loser in 2024?
I have no idea what the biggest loser will be, because I'm pretty sure that it'll be outside of, I guess if I had to guess, it would be banks with a big concentration of commercial office real estate. That would be my guess. I don't think that chapter has been written yet. I don't know what the biggest winner will be. I mean, I really don't, because I don't think in 1-year terms anymore.
Yeah.
It's ironic, having been an investor for 50 years with much less time on earth, that I've become much more patient. It isn't because I wouldn't like to be paid within a year. It's because my experience over the last 50 years is that I seem to be paid in 5 or 6 year cycles. And to superimpose my time preference on what the market gives me is naive. And so I choose not to do that. I continue to believe that if you juxtapose risk to reward and you superimpose a reasonable time frame, which is to say 5 years, that most of the market is hopelessly underallocated to oil and gas. And by the way, imprudently underallocated to gold. It's weird. Let me return to gold for a second. You set me off on a tangent, I'm afraid. We said earlier that the market capitalization of precious metals related assets in the United States was less than 0.5%. The 4-decade mean is 2%. Gold doesn't have to win the war against the US dollar. It needs to lose it less badly. If all we do is return to mean, then demand for precious metals related assets in the biggest investment market in the world increases fourfold. And that's precisely what I think is going to happen.
Wow. Fourfold increase in gold.
With a return to mean. All it takes is a return to mean.
Return to mean. Yeah. Yes. So it's a wild proposition. So essentially gold and oil and gas, more specifically gold. Yeah, I mean, to kind of put a nice little bow tie on this show, we've kind of come full circle back to gold. And, I just want to highlight the importance of your virtual forum coming up January 6th. Again, you get Rick Rule, you get Lobo Tigre, you get all of these brilliant investors. You're learning from the best. You're learning basketball from LeBron James. You're not learning, from your next door neighbor who's,
I don't want to underplay my importance, but you're getting Doug Silver talking about financing development. Doug Silver, in a very real sense, invented the mineral royalty business and was an important part in the streaming business. What you're getting is one of the pioneers of mine finance, who is going to do an hour-long presentation about understanding the capital stack in development. I guarantee you that 1.5-hour speech by itself will be worth the price of the boot camp. That one speech, understanding the financial stack, will be worth the whole price of admission, just like the introduction that Per Jander gave to our uranium boot camp, or Per Jander gave to our electric and battery metals boot camp. That one opening speech, the overview of the sector, is worth the tuition that I charge for the whole boot camp.
Yeah, and this covers. Does this go beyond gold? Do you guys cover silver? It's all kind of under one umbrella.
We talk about the development process irrespective. So the lessons that you learn will be of equal value in the uranium space, the precious metals space, or the base metals and industrial material space.
Yep. Link to that forum is down below. Be sure to sign up. It's $99. Well worth the price of admission. You saw Rick kind of lay it out there. Be sure to click the affiliate link down below. Would really appreciate it. If you enjoyed this content, guys, be sure to hit a like to the video, subscribe to the channel if you haven't, and follow all of Rick's work. We'll also have all of Rick's links and websites down below as well. Rick, do you want to send the audience off with any closing comments?
Well, finally, thank you. I urge people who care what I think about natural resources to find out on a personal basis. Go to ruralinvestmentmedia.com. List your natural resource stocks, and on a no obligation, for free basis, I'll rank them 1 to 10, and I'll comment on individual issues where I think my comments might have value. Then go to the Rule Classroom, absolutely free. 200 hours of educational programming for free. Learn how to evaluate precious metals and natural resources investments. It's absolutely free. The Rule Classroom has discussions of securities analysis. They have company interviews, 200 hours absolutely for free. Absolutely attend the boot camp. And once you've attended the boot camp, replay it several times. You can't get all the information that I'm going to give you in 8 hours. You have to replay it, and replay it with the lessons that you've learned in the Rule Classroom. And then, of course, to personalize that, have your own portfolio reviewed at ruleinvestmentmedia.com and ponder why your portfolio was graded well or graded poorly. We'll give you the tools in the boot camp and in the Rule Classroom to do just that. It's meant as an integrated educational experience.
Fantastic. Yeah, I mean, you heard it there, folks. Rick Rule is going to be cooking January 6th. Be sure to check it out. Link in the description box down below. Thanks for watching, and I will see you in the next video. Bye, y'all.